Let's get back to our bond discussion, shall we? Okay, we shall. So we left off talking about treasury bonds. Know that these are bonds issued by the federal government. The interest earned is subject to federal income tax, but is exempt from state and local taxes. So if you have interest earned from federal U.S. Treasury bonds, you're not required to pay any state or local income tax on the interest earned. Then you have what's called municipal bonds. These are bonds issued by state and local governments, often again long-term debt securities. So I want to make sure we understand why bonds are issued. Bonds are issued by the government or by corporations as a way of raising capital. So when the government needs funds, they can issue these bonds. So pretty much for the governments alone, when you buy a bond from the government, you are loaning them money that they're going to pay back to you plus interest over a specified time period. You got it? All right. So if you buy a municipal bond, again, these bonds are low risk because they're guaranteed to be paid back by the state or local government. Now, any interest earned from municipal bonds are exempt from federal income taxes. So it's just the opposite. If you buy a bond from the federal government, it's exempt from state taxes. If you buy a bond from the state government, it's exempt from paying federal income taxes. Okay? So any type of bonds that you purchase, there are also federal agency bonds, which are long-term debt security that are issued by certain federal agencies. These bonds, again, have low default risk, but the interest is taxable. So anytime you buy a bond from a governmental organization, those bonds should have low risk because that government entity is guaranteeing a repayment of those bonds. Bloomberg.com has a market section. It gives information on different type of yields, returns being offered on municipal bonds. And the terms, of course, will vary depending upon whether you're in New York, California, Chicago, etc. You can purchase these different type of municipal bonds, and they will indicate the rates offered by these different bonds. Now, you can also buy bonds from corporations. So AT&T, Google, Yahoo, they may all issue bonds as well. It's the same concept. When you issue a corporate bond, pretty much for the corporation, they are borrowing money that they're going to pay back to that bond holder at some point in time in the future and also pay them interest payment. So when you have these long-term debt securities issued by large firms, subject to default risk, what does that mean? It means there is a possibility that if you're buying bonds from corporation, that they're not going to pay you back what they owe you. I mean, most corporations will, but there are some who have defaulted and not paid the money back owed to the actual bond holder. You have what we call high yield junk bonds, meaning that these bonds offer you a higher yield, a higher rate of return, but you are taking on more risk. These bonds are issued by smaller, less stable corporations that are subject to a higher degree of default risk. So you must ask yourself, what type of an investor am I? Am I a risk taker? Am I more conservative? Or do I want to keep my risk to a minimum? So yes, you can buy these high yield junk bonds and they will offer you a higher rate of return, but just be cautious that you are taking on more risk whenever you purchase these type of bonds. All right? Corporate bond quotations. So the coupon rate is the actual rate of interest listed on that bond contract. That may be 4%. Maturity, indicates when the bond actually becomes due. And again, most corporate bonds mature between 10 and 30 years. Current yield shows the current market rate that's been issued by bonds. Now again, remember that your bond may have been issued in the month of January. It is now July. So the rates have changed. So the current yield can be different from the coupon rate. The volume shows the number of bonds that we've sold so far, and then the closing price shows the current selling price of the actual bond. Any net change in the price from the previous day to the current day will also be reflected. For example, here we go. Zugal Corporation, their coupon rate is 5%. The current yield is also 5%. We kept it simple. The current price of this bond is $100. It will mature December 1st, 2025. And these numbers are in thousands, so approximately 4 million bonds have been issued so far. This would be an example of the information you would see for a corporate bond listed in the financial section. The impact of interest rate movements on bond returns. If interest rates rises, the value of your bond decreases. So once again, when you first issued your bond, it was issued with a set interest rate that cannot change. If the rates are going up, meaning that there's other bonds now hitting the market, they're offering a higher interest rate, the value of your bond is going to decrease. But if interest rates are falling, they're decreasing, meaning that the current bonds are offering less interest than what's on your bond, then the value of your bond is going to actually increase. Okay? Tax implications on investing in bonds. Again, the interest that you earn off your bond is taxed as ordinary income unless they are tax exempt. So again, depending upon if you're buying certain type of government bonds, federal or state, a portion of the interest may be tax deductible for federal taxes or from state taxes. If you sell your bond at a higher price than what you paid for it, it results in what we call a capital gain, and you must pay capital gain tax. So to keep it simple, if you bought a bond for $100, but you sold it at $110, then you have a $10 capital gain, and you must pay a capital gain tax on that $10. Okay? So I won't go through all of this, but we're just saying that what happens if you purchase a bond for $10,000? Well, if you sold that bond after 8 months at a price of $9,800, and here we're saying that you receive a coupon payment, interest, for 6 months after buying the bond in an amount of $400. And let's say that you earn a short-term capital gain of $100, then the interest you earn will be considered ordinary income tax. And then the capital gain, because it is short-term, will also be considered to be ordinary income tax. So it all depends upon how quickly you sell those investments, whether you have to pay what we call a short-term capital gain or a long-term capital gain. It does impact the actual tax rate, whether it's a short-term capital gain or a long-term gain. If you sell a bond after having the bond for 2 years at a price of $10,200, so again, you receive interest payments. Those interest payments, you record those as ordinary income. Let's say you made a gain of $500 off the sale of the bond. Because it's 2 years later, now you would pay capital gain tax on that $500. Another scenario, you sell the bond after 2 years at a price of $9,500. Again, the interest you receive from the coupon payments will be considered ordinary income. We're saying this time you had a loss of $200, So now if you have a loss, there's something also called a capital loss. And that loss will reduce your taxable income shown on your tax return. So you will get to use that loss to reduce your taxable income. Okay? What if I hold the bond until it matures? Then all those coupon payments you receive will be considered ordinary income. And if at the end of 3 years you made a gain of $300, that $300 capital gain would be taxed at the capital gain rate. Okay? So the interest earned on bonds or the capital gain from the sale of a bond is considered to be taxable. The rate does depend upon with the capital gains, whether it's a short-term capital gain or a long-term capital gain. All right? So how do we determine the actual value of money? We use what's known as the present value concept. All right? So for those who have taken your accounting classes, you should know more about how to determine present value. So we have calculators that show you present value. So we look at the present value of those coupon payments, the interest payment, and the present value of the principal payment or the par value. So when you add those two amounts together, that determines the actual value of that bond, the present value of the bond's coupon payment, the interest payments, plus the present value of the bond's principal payment, which is going to be the face amount. Economic impact on bond values. High rate of returns is only realized if firms are healthy enough to make payments. So we're saying that as long as those firms issue the bonds or in a good position financially, then that's going to yield a higher return to the actual investor. This may not be true if there are unfavorable economic conditions. So when the economy is not doing well, the firm may not have the resources to pay what's owed back to the actual bondholder. Once again, Bloomberg.com, one of my favorite sites for information on finances, it has a section on the bond market. So before you decide you want to purchase bonds, I recommend that you go to this section and review the information on how to purchase and sell markets. All right? Default risk. What is default risk? The risk that the borrower of funds will not repay the creditors. Again, the risk of that the borrower of funds will not pay the creditor. So again, once you purchase bonds, you are taking a risk that you better not get your money back from the person who you loaned the funds to. Now, once again, if it's a government bond, the risk is low. If it's a corporate bond, you're taking on some risk. So you have what's called a risk premium. The extra year required by investors to compensate for the risk of default. So I talked about those junk bonds. Junk bonds are bonds you purchase from companies who are not as stable financially. Therefore, you're going to request a risk premium. So let's say the average interest rate on bonds may be 4%. But because this company is uncertain or they're unstable financially, you may require a 6% return before you purchase their bond. That 2% is known as the risk premium. Now, how do we know if there's risk when it comes to buying bonds? How do I know if I should expect a risk premium? That is an excellent question, and stay tuned to the conclusion of our discussion on bond investments.